Good day, fellow investors. Ben Felix came out just with a video about how you cannot do what Warren Buffett did by yourself. However, even that what Warren Buffett did is not that significant if you just look at the right factors. The key message is that active management is not smart, but let's discuss Ben's video and then I'll give you my opinion on active management, passive management, investing, index investing, performing, outperforming, and how does it all fit you getting richer? That's the key at the end. And let's immediately start with Ben Felix, who then shows how Warren Buffett destroyed the market for eternity that he has been managing Berkshire, but then immediately he also shows how from 2003 for 22 years, we'll discuss the 22 years time picking later, Warren Buffett has not outperformed the Vanguard Total Stock Market Index Fund. The reason being diminishing returns due to scale. As Warren Buffett is getting larger, and larger, he cannot move as he did in the past, and therefore for the last 22 years he has been underperforming. And the larger the asset base is, the harder it is to outperform the market. Also, the question is whether now can any stock picker follow the oracle, and how Ted and Todd, that have been Warren's managers, are underperforming Buffett, Berkshire, and also the S&P 500. Then Ben Felix discusses how even Buffett says that the best way to own stocks is through an index fund and that you will beat the majority of professionals. Discussing Warren Buffett's 2007 bet, how he bet that $1 million will do better than the actively managed funds from another investor, and how he is also setting up his wife's trust into 90% S&P 500, low cost. So even Buffett is going into the S&P 500 for his wife, and how he, Warren Buffett, knew just 10 active managers that could consistently beat the market in his life, and Ben Felix says try picking one of those. Therefore, most people should not pick individual stock. Here is how to invest instead. Index funds, or as Ben Felix discusses, it is better to invest in index funds that have cheap quality with some leverage, which is Buffett's alpha, how Buffett made his returns over time. He then goes into academic research and discussing how if you separate the factors investing that Warren Buffett used, there is not any statistical significance into what Warren Buffett picked stocks with. So the key factors are there. Outside of that, there is statistical insignificance in Warren Buffett investing. And Ben Felix goes forward discussing how it can be replicated what Warren Buffett did with more diversified exposure, of course, through funds, and he is such a manager that tries to outperform the market in this way, looking at what Warren Buffett did, what are the drivers of return, the factors that Fam and French discussed, and that the research shown on Warren Buffett, size, price, profitability, and that is what they are doing. We know now these factors and we can replicate what Warren Buffett did, chasing those premiums, and then hopefully beat the market. Building portfolios matching Berkshire that have the same idiosyncratic volatility, total volatility, and relative active loadings, and you can perform comparably to Berkshire Hathaway. So you have to stick to those principles, and Warren Buffett's genius is just that he recognized those factors before others, and we know now those factors, and we can stick to those principles and do well. And then on the question of Buffett's cash allocation, there was this question always how he says invest in index funds, but he doesn't do it, and then the answer here is because of size. However, there is the opportunity cost in longer bull markets, but that is okay for Warren Buffett. Now, if you know an active manager that can beat Warren Buffett or the market, you should invest with them. But if not, low-cost index funds, and here Felix agrees, but he would add also outside international diversification, because those factors should further do well over time. And this is what he sells: diversified systematic strategies that tilt toward factors with higher expected returns, like safe, high quality, cheap stocks plus a bit of leverage. And implementing Berkshire's strategy based on that factors should be more likely to be successful than you reading financial statements and picking your stocks. And of course, you can get all of that at PVL Capital. So he then finishes the video by saying, please send that video to everyone that talks just about Warren Buffett and investing, which is me, and that is why I got this video to discuss. So please, from now onwards, send this video to anyone that is investing with Felix or in index funds. Let's start. The first mistake he's making, he's looking at the past, because when Warren Buffett did his performance, nobody knew about those factors. Now Felix and everyone else knows about those factors, and they are trying to implement. Once people know about those factors, then the competitive advantage is gone, the premium is gone, and it is unknown whether you will continue the performance there, as it was the case over the last 50 years. And then just a little tip on international diversification: Vanguard S&P 500 Index Fund, 0.04% fee. If you go internationally, the fees are higher because you require more knowledge, so you as a fund manager make more money. Now, when it comes to active versus passive investing, I think that the S&P 500 is a great business and a great product. Nothing wrong with it. But what is the essence of value investing? That is the key question I want to ask you. Pause the video, answer the question: what is the essence of value investing? And then write it down, then let's check forward if it's correct. The essence of value investing is price paid versus what you get. Price is what you pay, value is what you get. That has been Warren Buffett's mantra since ever, and yes, he invested there where he got more for what he paid for. That's the essence, and you can then turn it into all two factors, left and right, but he switched between factors depending on what was cheap. That's the essence of value investing, and that is what is missing from Felix's academic perspective on things. Yes, academics look at what Buffett did and say that if you replicate, because backtesting shows it, it will work even better. But that had happened into the last 50 years, and the question is how it will work in the next 50 years. Because when it comes to active, passive, outperforming, I have a small issue with that. Now, when you are making love to your spouse, do you think about outperforming somebody, or do you enjoy the performance? Do you want to perform or compare yourself to someone else and outperform? And I feel pity for all those managers, including Felix, that are forced by their job, by everything, to outperform. If you don't perform, then you're just like the index. I don't care about outperforming, I care about performing. So what we do here, what I do, and what Warren Buffett does, is let's kick the out of outperforming and focus on performing, which will give you a different perspective on investing. Active is good, passive is good, everything is good if you can perform and reach your financial goals. That's the key factor there. So let's dig into performing. And that's exactly why Warren Buffett's cash allocation is now where it is. Not because of size or things like that. And Felix says that if you don't manage billions, you should be fully invested in his funds. This is Berkshire's allocation. Why? Because Warren Buffett wants to perform. He doesn't care about outperforming. With a 3-month treasury at 4.3%, 325 billion, Warren Buffett knows that he will get 14 billion for sure. We just discussed GMO's forecast for the market, and at the current situation, the market might be 50% down in the next 7 years, flattish in the next 10 years. The market is now up just of valuation expansion. That's a game Warren Buffett doesn't want to play. And that's also why we discussed also on this channel a lot of crash situations, the risk and reward of the market. And I even looked at all the ETFs, value ETFs, and yes, emerging markets are cheaper than the others, but not cheap on that perspective. So if you go into those factors, international or whatever, you are still paying a high relatively historical price for things. And all you need for investing is why Warren Buffett sold, because of the crazy valuations. And when it comes to performing versus outperforming, this is the key. If you look here, let's say the market is down 50% in the next 7 years. Would you be a happy chump if you are down just 30%? Oh, I have 10 million, I lost just 3, everyone else lost 5 million. Would you be happy? That's the key question, and that's the key issue with asset managers out there. Over a cycle, I don't care about outperforming. I care about performing, doing my thing, and whatever the market does, I couldn't care less. And Warren Buffett knows that over the next 5 years, even if the market is down, Warren Buffett knows he'll get his 20% from treasuries for sure. He will get richer for sure, unlike with maybe index funds, maybe not, maybe yes. And therefore we come to the driver of investment returns, not those factors. It is price paid in relation to cash flows delivered through dividends, buybacks, or reinvested for growth, quality, moats, leverage, and how much there is leverage, which leads to risk. When you put those factors into an equation, then you know, okay, will this investment now for sure increase my long-term wealth or not? Everything else is gambling, and that's exactly what these asset managers do that are focused on outperforming the market. They go around and gamble with your money for the fees. That's it. So when it comes to the question of active or passive, active, good if you find a good investment. Passive, good if it is a good investment, just so that you can perform in your investing life. The key is to get rich for sure. And also on Ben Felix, it's true, we are all here for the fees. That's why he is here. The key issue I have with that is that what have worked might not work again, because if you're not focused on the price, that's not value investing. And as he says, he's still trying to outperform. And he's trying to outperform because with the billions of managed by Wall Street, including himself, high fees, it's usually the managers who reap outsized profits, not the clients. And that's why also he took a 22-year comparison with the index fund. I compared with others, 5 years, Berkshire in line, 10 years, Berkshire in line, little bit with the dividend, then we come to equals. But why didn't he take 30 years? Berkshire destroyed the market in 30 years. And the key factor here also not mentioned into the comparisons where Berkshire did similarly is risk. For the last 10 years, Berkshire did equally to the market, let's say, but with a huge cash allocation, insurance, this and that, with much less risk than the market. That is something Ben Felix did not mention here. He just selected the worst performing comparative longer situation and then he went on it. Look at this. Worst selective potential 22 years ago, and then the greatest financial bubble in history, and then you compare it with Warren Buffett. Now, what I say is that you have to select the best for your life performance. Perhaps that is even Ben Felix's funds, but you have to check how those fit you. When it comes to the just index fund, I think this is the current situation with the market. It can double in the next 7 years, it can be flat in the next 7 years, and it can drop 50% in the next 7 years. This can be the outcome, and you have to see how would this outcome fit your current life situation. If you're happy with this because you know you can 3x your investments If the market crashes, then be my guest and invest passively. But this is when the S&P 500 gets my yes. When there is little risk of doing badly, of losing money, that is value investing. What has Warren Buffett been doing, no matter how academics want to show it in factors? Because what is value investing? The market is expensive. Oh, look, maybe now the greatest value to my life is building a new kitchen. Just always compare the risk and reward. A kitchen will serve you for sure for the next 10-20 years. The market might not. That's value investing. And if you look at the 7 years that I have been on YouTube, my best advice was the beginning. I always said, guys, 30-year mortgages at fixed interest rates are free money. And many of you took that advantage. In the meantime, with our stock market performance on my research platform, we performed in line with the market. But the key message I have now is hedge yourself because of the risk and reward. See how the risk and reward fits your investment's life situation. I'm mostly hedged now, especially personally. I'm 100% hedged. And then I can see over the next 7 years, will I do flat, better, or great? I don't know. But if the market keeps on going high, I'll likely do my 5 to 10% per year, even higher. For the last 7 years, did 12%. If there are some shocks, I'll do much better. But that is the game. I don't want to be down 50% or down 30%, compare myself to the market. So please, if you know anyone that likes index funds or Ben Felix, share this video with them. Thanks for watching. I'll see you in the next one.